Good morning, students. How are you all? So let's start with today's class with the chapter number 7 of Unit 3rd. In the Unit 3rd, we have already read about the production and the cost. Now this revenue. What is meant by revenue? First of all, we will find out that. Then we will discuss in this chapter about the total revenue, average revenue, marginal revenue under the perfect competition in the monopoly market structure. And then we will discuss about the relationship between the TR, AR or MR. This is the main concept of this chapter. It's a very small chapter. So let us study about the what is meant by the revenue. What is mean? The total amount or total money that a producer receives in exchange for the sales proceed. It is known as revenue. Total amount money value received from the firm of the industry by selling the goods and services, that is revenue. Here I will give in one example. For example, if a firm produce 100 units of commodity, any commodity you can count, pencil, eraser, whatever is there, per day, and sales it is 20 rupees per unit, then its total revenue is 2000 rupees per day. The revenue can be classified into three categories such as total revenue, average revenue, and marginal revenue. Each curve have a different characteristics for a different market structure. So let us discuss about that also. So here first of all we will discuss about the total revenue. What is meant by total revenue? Total sum of money value received from the sales of various quantities of output of product produced during the given period of time at certain price level. It is known as revenue for a firm or industry for that time period. It can be obtained by multiplying total output sold quantity by the corresponding whatever the price is there. So you can say that total revenue refers to the total receipt from the sales of the given quantity of a commodity. So what is this means? If you want to find out the total revenue, what you have to do, you will just multiply the total revenue quantity with the price and you will get that total revenue. So now this is the formula of the total revenue formula is given here, TR P into Q. So this is the next we are discussing about average revenue. Per unit revenue of a product is known as average revenue. We obtain average revenue by adding the TR by the corresponding quantity, dividing the TR with the corresponding quantity. The formula is given here. Then the marginal revenue in an additional amount of money received from the sales of one additional unit of the product. So we can get the marginal revenue. In other words, marginal revenue is the change of total revenue due to change in the quantity sold in the market by one unit. So here the delta equals to change, delta TR equals to change in the total revenue, delta quantity change in the quantity sold in the market. Now we will discuss about the curves. That is very important in this chapter. That is the main thing given here, and in the different market conditions. So first of all, we will discuss revenue curve under the perfect market competition. So under perfect market competition, what is this? Perfect competition is a market structure in which the large number of sellers sells the homogeneous product to a large number of buyers. What is meant by perfect competition? In the perfect competition, there is a large number of sellers and large number of buyers are there, and they are selling homogeneous products. They can enter in the market and they can exit in the market according to their not any rules and regulation. There is no restrictions is there. They will communicate to each other very easily these prices are just remain same with each other, those are called the perfect competition, perfect market competition. There are large number of buyers and sellers, so they cannot individually buy or sell can influence the smooth functioning of the market. That means neither individual seller nor buyer can change the price of the product. This structure of market firms are the price taker, not a price maker. In the perfect competition market, a firm or an industry sells its output at the given price. The price is determined by the market. Whatever the price available in the market, it is according to that. The total average and marginal revenue of a competitive firm are illustrated under as follows. First of all, we will discuss about the total revenue under perfect competition. Total revenue of money value received by the producer by selling the various quantity of the product in the market at constant price. It is known as TR. TR means total revenue. In case of perfect competition market. So here the perfect TR is obtained by multiplying amount of output sold by the given price determined in the market by intersection of the market demand and market supply curve. So P bar equals to shows that the market price which is constant, means here we are taking one price that is constant. With the help of table I will explain you. Units was 0, 1 to 3 units, those we are going to be sold or output 1 to 5. Market price that is constant, means it will not change according to the output unit, according to the market condition, that is same, remains same every time, 10 rupees. So the total revenue, what we are doing for find out the total revenue, what we have to do, we will multiply the output with the price and we get the price, we get the total revenue. So here 10 into 2 equals to 20, 10 into 3 equals to 30. So the above table of the total revenue is obtained by multiplying output and the price. When the output is 0, TR is also 0. When the output increases accordingly, likewise that the revenue, total revenue is also increasing. So this is the way. This is the table shows that as per the total revenue, as per the quantity increases. Here the quantity is given and sold for quantity sold, your output you can say sold, and here what is this 10, 20, 30, 40, 50, this is the total revenue we get by the price of the selling TR. So this is the graph shown by that. Now we are discussing about the average price.